Now let's go over key points of both traditional and Roth IRAs. With individual retirement accounts, they're used as supplemental retirement savings for an investor to put money aside outside of a work-sponsored retirement plan. Contributions into an IRA are set at a maximum of 100% of earned income, or $7,000, whichever is less. If an investor is age 50 or older, there's a catch-up contribution, allowing the investor to add an additional $1,000 per year as a catch-up contribution. Spousal IRAs are also available. That means you have a working spouse who decides to set up a IRA for their non-working spouse. And anytime we've put in too much money per the IRS, they will charge us a 6% penalty on the excess amount until we take it out. One of the things that I wanted to do was take a look at some of the different characteristics of IRAs and look at them for traditionals and Roths side by side. For example, both for a traditional and a Roth IRA, contributions can be made up until the investor's tax filing deadline, which is traditionally April 15th, the year that follows the tax bill. The tax status of the contributions. For a traditional IRA, our assumption is always going to be that it's before taxes. With a Roth IRA, we assume that this tax status is after tax, our contributions that we've already paid taxes on. Both traditional and Roth IRAs grow tax deferred, meaning I don't have to pay any tax on my earnings until I take the money out. Traditional IRAs do not phase out your ability to contribute based on income. That is only for a Roth IRA. Once an individual tax filer makes more than $144,000 per year, he or she can no longer contribute into a Roth IRA. The same thing holds true for a married couple. If however, the phase-out income is a little bit higher. It goes from $204,000 to $214,000 for married and filing jointly. For traditional and Roth IRAs, let's take a look at the following features. Traditional IRAs are subject to a required minimum distribution, while a Roth is not. Investors have up to April 1st, following the investor's 72nd birthday, to make a contribution into their traditional IRA. If the RMD, required minimum distribution, is not taken in time, there's a 50% penalty on the taxable portion. With both traditional and Roth IRAs, withdrawals before age 59.5 are subject to taxation on the taxable portion of the withdrawal, but also that taxable portion is subject to a 10% penalty. There are penalty-free withdrawals before age 59.5. Both include death and disability, higher education expenses, first-time home buyers up to $10,000, or the investor is taking substantial equal payments under Rule 72D. Taxation on withdrawals after age 59.5. For a traditional IRA, your taxable portion is going to be taxed at ordinary income. For a Roth IRA, if the investor has held the money in the account for 5 years and they're over the age of 59.5, the money is not going to be subject to tax when they take it out with a Roth IRA. In this session, we've talked about traditional and Roth IRAs. Go over to millionairesintraining.com and practice with our testing exam simulations. Get good with these. You'll never see the same exam twice, and the questions are asked in different orders with different explanations. You're unlikely to see multiple questions on the same exam twice. Please go over and do this and focus and practice and study. If you want to pass, put the work in. Get your scores up with our exams. Stay disciplined, because you could become a millionaire made at millionairesintraining.com.